Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Please do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Registration is now open for our next event, the Planet MicroCap Showcase, which is taking place in Las Vegas at the Horseshoe Hotel and Casino, formerly Bally's, on April 25 to 27, 2023. Expect 3 days of networking, company presentations, one-on-one meetings. In short, a lot of fun and getting work done. If you follow our community and especially invest in microcap stocks, you're not going to want to miss this. Expect more announcements on speakers who may be there to pitch a few names, as well as the presenting company list. To register and attend, please visit www.planetmicrocapshowcase.com. See you in Vegas. Now, for today's show, I invited on Eden Rahim, portfolio manager for the Next Edge Biotech and Life Sciences Opportunities Fund. It's been a bloodbath for biotech in the last 2 years. According to the S&P Biotechnology Select Industry Index, the sector has been down approximately 45-50% during that time. At the same time, in 2023, also according to the S&P Biotechnology Select Industry Index, the sector is up about 4 to 5% already on the year as of January 2023. Whether this is a sign that things are looking up for biotech is still too early to tell, but I felt it's worth discussing why it's been hard times in biotech in 2021 and 2022. Eden and I also discussed what he's looking for amongst the biotech rubble, in particular, why it's so important to pay attention to how phase 2B clinical trials are constructed. We close out with his biotech predictions for 2023. Thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Eden Rahim. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Eden, thank you for joining me today. How you doing, man?
Pretty good, Robert. Thank you for having me.
Absolutely. Well, I wanted to have you on here today because, we here at Planet MicroCap, we're sector agnostic. We cover everything from healthcare, tech, mining, all of it. And, now we're here at the beginning of 2023, and I wanted to kind of do a recap on, how 2022 was for healthcare life sciences, looking ahead, looking at a little bit of data, and just kind of a couple other things that I've noticed that
I mean, I find them interesting, but we'll talk it through here. So, and also shout out to Deborah Honig from Adelaide for introducing us. So thank you, Deb. And yeah, here we go. Rahim, the last 2 years in biotech, it's been a bloodbath. What else are we going to say, right? According to the S&P Biotechnology Select Industry Index, this sector's been down about 45, 50%. What for you, in your opinion, why has this been the case? And how come 2022 didn't fare much better than 2021 for the biotech industry?
Sure, great question. So what the sector peaked along with a lot of long duration assets like EVs and stuff like that. The sectors that benefited the most from ZIRP, from zero interest rate policy, very low interest rates, and so on. That benefited the most from it. They all peaked in February of 2021, and as markets often do, they anticipate a changing regime well in advance. So there was a bit of a speculative blow off in biotech, along with several other small cap focused sectors, when the 2-year yield was down at 10 basis points. From that point on, it started to rise. So these long duration assets, their valuations are inversely related to changes in interest rates, especially real interest rates. And so that rose steadily through 2021. The S&P Biotech Index fell 20%. Then came 2022 when the Fed got very aggressive and virtually every asset class fell. The TLT fell at a stunning, 30%. It's amazing to see a bond ETF fall like that. The S&P Biotech Index fell another 26%. So peak to trough from the Feb 7, 2021 high to the June 2022 low, the S&P Biotech Index was down about 65%. And that's the fourth worst biotech bear market in history. And what's different about this one is that this one didn't follow a gigantic bull market. Biotech has been meandering in a range now for 7 years since the peak in 2015. The other similar bear markets all followed gigantic bull markets. So the worst bear market was the 73%er in 92 to 94, was 3 years, and that followed a 4 years 800% bull market. The 70% bear market in 2001, 2002 followed a 1,000% bull market from 1994 to 2000. This one, there was no such thing. So what it's effectively done is taken biotech stocks down to valuations I have not seen in my career. So it's a variety of things. We have the interest rates, we have the risk off positioning as the market became concerned. Yield curve increasingly inverting, which in a sense, believe it or not, is actually not a negative for biotech. I'll get into that later on. And the inability of companies to raise capital. So what happens is the market in 2022 started to look forward and say, well, let's separate the cash flow now giant biopharma companies, which we know will continue to generate revenue growth through recessions and so on, versus those that will burn through their capital, incinerate before they even approach commercialization, and will be, like birds, chicks with their mouth open, waiting for the parents to drop food into it. That's what small cap biotech was like. This constant need for funding for R&D. And so the market just pushed ahead and said, we're going to just take you down 90% because you're going to dilute shareholders into oblivion. And so that's how you get that dramatic valuation. And I've quantified exactly what the magnitude is by deciles and so on. And I think I sent it to you.
Absolutely. I mean, it's so interesting when you take in macro market conditions and you start thinking, and then you apply that to how you should think and evaluate, we're MicroCap pod here. So, companies in the biotech space, 300 million market cap or less, because nothing really changes in the sense that, these are companies that they're always going to be having to raise capital for the most part. Right. I mean, not everyone, some either, get taken out or they do a good phase 3 or phase 2, whatever. But for the most part, they're always going to be diluting, so it's always interesting when, you see that, the macro, and then you start thinking like, wait a second, so it's just fascinating when these times happen. And you've seen it a couple times now.
And that's a function of sentiment. So when things were ebullient back in early 2021, companies could raise capital at will. Small, even small cap companies. And
real quick, and let's qualify that too, because in terms of raising capital, like that can mean multiple different things. So at that time, when they were raising capital, it wasn't as value destructive, would you argue, or because share prices were much higher than they were today, they were raising them at better prices, right? So compared to what they are right now, because it's not that they can't raise capital right now, it's just way more difficult, and you're getting it at let's just say in structures that are not the most shareholder friendly.
That's exactly right. So when the market's buoyant, they're opportunistic, and it's incumbent upon it to do it because they are spending shareholders' R&D, shareholder funding to fund R&D to generate ultimately, hopefully, long-term wealth. And but now many managements are facing a really difficult choice because the market's already anticipated that they're going to need funding. So they have a couple of options: either put themselves up for sale or face the music, go and dilute. They have to add lots of sweeteners like, at the money warrants, 5-year warrants, all these sort of things. So it's definitely a buyer's market. And so there are companies. But the other thing too is that you really have to separate now, because you can get really good mid to late stage companies at valuations the same as early stage or sometimes preclinical companies. So, there are gems buried in this entire rubble that are worth pursuing and worth investing in, that will generate huge returns. And, we've seen it. Well, what I've actually done is I've actually pivoted, so we had some winners, big winners like CPRX and so on, which is being taken to the woodshed today. But, we were in at 255. We sold our entire position at $20, and because we figured, it was actually rich, and now they need to do acquisitions to continue earnings growth and so on. So I said, that's not why we're in. So we sold our entire position, and we pivoted and used all the proceeds to buy promising late phase companies trading well below net cash, huge discount to net cash, have catalysts coming up. And so we figured that the risk reward is way better. They've already been through Armageddon. What risk are you taking buying a company at selling at 1/3 to 1/2 net cash with big catalysts up ahead, right? And so we are doing that this quarter. It's not necessarily that it's bullish, it's that the market's laid that opportunity on the platter for us. And
yeah, no, I would say, to follow up on that, you mentioned how there are, hidden gems that you're finding amongst the rubble. And you mentioned a couple of your criteria here, trading at, I think you said 1/3 of net cash, and then, big catalyst coming up. Tell us a little bit more about, what you're now looking for amongst this 2-year ash heap of a biotech industry that's been.
Well, so I want companies with, significantly de-risked pipelines and technology. So some of these companies are in early commercialization, and the market is pessimistic as to whether they can achieve profitability. And that may be the case, but there's steps that they can take, and they also have the cushion. So one of the other things I do when I screen, so I screened over 1,300 healthcare companies based on net cash, so cash and cash equivalents minus debt. I looked at things, debt maturing within 1 year. I divided the net cash by the EBITDA to see how many years of burn were available to them. So, if you've got multiple years of cushion, you are not compelled to come to the market in this valuation. Some of the other things I looked at was a relatively thin float. So they have a float of around 10 million or less. So, versus companies that have 100 million. And so, and you whittle down this universe down and down and down. into, about 10 companies that we think the risk reward is set up really well. And again, all the CPRX proceeds and a few other companies that had defensive properties, and CPRX was hitting an all-time high, up to a week ago. And so we bowed out and said, we're going to get a pretty good trade, we think, in Q1 and Q2 of 2023 that we have not seen in 2 years. And so, those are some of the things I looked at, and it was a lot of work because you're going through companies, you're whittling down, you're going on and you're listening to conference calls, you're running through all their decks, and you start with a couple hundred companies and you whittle it down to 100, then 50, then 25. And, finally you get to about 10. And then after 10, you decide which 5 or 6 you're going to buy, right? Take a 1.5% weight in each of them. But, for these positions, you're playing because you think they can be up 200 or 300%. If the market just gets less pessimistic about them, which we think is possible. So that's the approach for this component.
Absolutely. So it's interesting that you brought up, at this time that you're mostly looking at the, early commercialization stage type companies, so are you just completely ignoring right now some of the companies that may have, late stage phase 2, even now in a phase 3? Are you kind of avoiding those at the moment?
Not the phase 3s,
Okay.
but pre-phase 2 readout, I'm always skeptical of those, except for companies in the CNS, central nervous system space, neurology companies. The market values those companies differently based on phase 1 data than it would oncology or anti-infective companies or or antibody companies. They get valued very differently. It's way more competitive in those spaces than it is in CNS. FDA conditions for advancing trials and approvals are very different for CNS versus other areas. So they get valued differently. So that's the only place I make an exception to the rule. Otherwise, virtually every investment I pursue in the clinical development stage are phase 3, which is the wheelhouse for me. And it's based on the fact that 70% of companies fail in phase 2B. So pre-phase 2B, managements can make all these grandiose claims about how their, open label phase 2 data is better than that billion-dollar commercialized drugs. You see it all the time, and it's annoying, right? Stop comparing apples to oranges, but they make this claim because they want to encourage retail investors to buy their stock and subsequently do financings. And, to a degree, I understand it, but it's annoying. And so I pay no attention to that. And focus instead on what that phase 2 data is, how that phase 2 trial was designed. I speak to key opinion leaders to say, if this drug were approved based on the data that you've seen, would it matter to how you treated patients? Would it be first line, second line, third line, things like that? And if it doesn't really move the needle for them, I'm not interested. If they think it could be a game changer and there is a big role for it, that's when I'm interested. And that's when I tend to invest in these companies and hold them through phase 3 into commercialization. Because now you're changing the failure rate from 70% to under 40%. And then you can further handicap the odds by different variables. The design of the phase, how effective was the phase 2 design, how broad it was, how much information you gathered, and how much you can power the phase 3 for that. How much of an unmet need it is, how much of a, how poor the standard of care is, versus what this drug has to address. And all these things factor in as to where I am going to invest and how much of what weight I'm gonna take in that investment.
I'm so glad you brought up this point because when we were talking offline, there was one company that I just was following that just had, they had a failed phase 3, or for lack of a better term, a shitty phase 3 results. Pardon my French, but it was that. And
we're in this industry, that's the language. Yeah.
Yeah, right. Yeah. I can already hear the PhDs being like, yeah, these were shitty results.
Yeah.
But and so when I saw that news, I realized that on the pod, we hadn't really talked about why it's important to really understand, once a company is in phase 2, phase 2A, phase 2B, why it's really important to analyze how that clinical trial is structured, basically what you just said, because at the end of the day, that, it sounds like it doesn't mean much, because once you get to phase 3, that's really when, that's when the meat and potatoes really come home to roost. These management teams can make all these grandiose claims, because that's something that folks should really understand when a company's in that phase 2 time period. That's not to say to just completely distrust anything management says that currently has a phase 2 ongoing trial, but you really need to pay attention.
Yeah, the phase 2 design the phase 2B design is way more important than people put credence to. And you want to do the heavy lifting in a phase 2B, because you want to power the phase 3 based on all the breadth of information that you've gathered in the phase 2. And time again, we see microcap and small cap biotech companies actually try to get through enough on a phase 2B, and then hope for the best that they'll partner for phase 3. And what you end up with is all these mothballed phase 2B trials where they didn't really answer a lot. The N was small. They didn't measure a lot of secondary endpoints. The patient population, there were doubts as to how appropriate it was, what the screening criteria was to get patients in, how reproducible it is. And so when these questions don't get answered, I see time and time again, the small cap companies, they're so happy they managed to squeeze through a phase 2B. And then they work on a large phase 3 to try and answer these unanswered questions. That is a huge risk factor. I think, a lot of the failed phase 3s result from that, versus a well-designed phase 3 where a lot of those things are answered going in.
What are some indicators of that? Like, let's say you're a lay investor that doesn't know how to analyze or look at a phase 2B, structure, clinical trial, are they answering all the endpoints? Because like the first thing that comes to mind for me is like, okay, we're out of phase 2B, positive outcome,
yep.
Whatever. Now we have to gear up for phase 3. Is that when you start seeing most of these companies raise way more capital than they probably need? And that's usually an indicator.
So what happens is I like to invest in a post phase 2B financing, or I'll wait. So what will typically happen? Suppose you report successful phase 2B data. It goes on my radar and it starts to become interesting to me. I'll look into it. So invariably, the market is pretty good at assessing how big an opportunity it could be for the company based on the data and how it stacks up with available treatments. So that's probably one of the first things, the market indicator as to the response to the phase 2B data. If the opportunity is huge and it's a novel mechanism of action, especially, and the phase 2B trial was designed where you can now go back at phase 2B trials of successful drugs in the indication and say, yeah, you know what, this was a well-designed trial. It stacks up the same questions that were answered in Merck's phase 2B or Roche's phase 2B. They actually address those here. The first red flag is when you start to see that in their phase 2B, they haven't answered questions that were answered in a large pharma or biopharma company's phase 2B. That's the first red flag. Then the second thing you do is the company will spike and they'll raise funding on it, and then the stock will just drift down. It'll drift down and down and down. And then at that point, what you want to see is the peer-reviewed data. So they have to publish. And so now it's open to scrutiny. Initially, sometimes you'll often see that report top-line data, and the more granular data will be reported at a conference. Maybe it gets in as a late breaker, something like that. And then you get to really peek at the data in greater detail. You want to see that stand up to scrutiny. And so the best entry point, for me, historically, is at that point. It spiked up. It's done this big financing. It weighs on the stock. It drifts back down. So now you can buy if it stands up to the scrutiny and peer review. Think about this: you've got a bunch of PhDs that are fighting over each other as to what the merit is of this data. They're way better at it than I am, than I will ever be. So I'm reading. It's a combination of reading the tea leaves between what the market is doing and what these experts, what their perception is of what that data is. So now you can come in without having to take the risk of phase 2B data, right? So you remember the failure rate is 70%, and in some indications even more. So now you can buy in after it's spiked up, maybe 100, 150%, and now it's retraced half of that. You can now buy it, 3, 4, 5 months down the line, at 50% of what it was, 50% higher from what it was pre-phase 2, but you've got all this information. Now legitimately they have a drug that potentially works, a competitive drug. The leading key opinion leaders in that indication think it's interesting, or it's good, or it could make a difference. So you've got all this important information now. So I don't mind paying more without having to face the ambush of an 80% drop in phase 2B on a field trial, right? So this is how I come at it. And so for me, it's a much better risk reward setup for the long term to position it at that point. Because now I've got 2 or 3 years ahead. They could potentially partner it to allay some of the development costs and so on. And that's where my best positions turn out to be in a scenario like that.
Absolutely. That is really great insights. And so, I mean, real quick, what resources do you use to find, maybe to filter out companies that have, peer review data already out there? Something like that.
I use things like Biopub and so on. I also use Bloomberg's Catalyst Calendar and plus a host of screens. I use clinicaltrials.org. That's probably the best source for looking at trials and peer review trials and so on. But on Bloomberg, I screen based on indication. So if there's an indication that's targeted, I can screen all the companies that are in similar stages of development in that indication, in that program. And so that's another primary source. And then I'll go through and look at what they have that way.
Very good. All right. So that concludes our talk. I really wanted to talk to you about that today because, and I'm glad you brought that up talking about. So if there's one thing that you took away, whether it's a current market sentiment, anything like that, no matter at what point we are in the macroeconomic, how things are relating to one another, definitely listen to what Eden said having to do with phase 1, not even phase 1, but at least phase 2, phase 3 trials and understanding the key differences there and what you can look for. So now wanted to quickly transition because, going back to, thinking about where we're at right now, maybe we're coming out of this, 2-year bear market, whatnot, were you at JP Morgan this year? Did you go to the healthcare conference?
I used to go in the 90s and early 2000s. Okay. And I stopped going. It's a zoo. And it's chaos and everything's overpriced. So I prefer to go to smaller firms, where it's not crazy like this. I can meet the companies I want. There's smaller boutique firms in New York and Boston and so on that I like to go to. I was most recently at the Wainwright conference, AC Wainwright conference in New York in September. I got to meet a lot of great, interesting companies. Some companies I position in that are now up 100+%, and you can see them really bounce back. And you get to meet these companies. In JP Morgan, it's just crazy. It's a zoo. It's like I'm just not interested in that.
Fair enough. No, I was only I wanted to
I know.
preface that only because I figured everybody in healthcare usually goes there.
So it used to be called what was it, the Hamburg and Quist. That's how it actually started out. It was a boutique in San Francisco, and they were early in the biotech development cycle, and they put it together. And then JP Morgan bought them in 2000, and that's how JP Morgan actually got into biotech.
Very good. Well, I want to. So then, I was going to preface that for my question about sentiment. Now going
Yes.
forward, but I do have some other stats that we can use for the sentiment question. So here we go.
Sure.
We just rebalanced our index that we follow here. It's a generalist microcap, Planet MicroCap index. Healthcare companies, the top 50. We have the top 50 by performance. The average performance of those companies was about 150.5% in Q4 2022. And then, in 2023, according to S&P Biotechnology Select Industry Index, the sector is up about 4 to 5% already on the year. That's as of on Friday, January 20th. So is there a change in sentiment that you're seeing right now? Love to hear your thoughts there.
Yeah, sure. So there are several ways that I measure sentiment. Some of these are proprietary indicators, and we'll talk about them and what the readings were and sort of the multi-year extremes that they've hit. So you're spot on. For people in microcap and small cap biotech, December was horrible. So a lot of these companies have been basing, for 2 or 3 months, and then on zero fundamental news, they just went off a cliff. And, a lot of these lost a third to a half their value on nothing, no news. And it was just tax selling, portfolio window dressing, that sort of thing. And they went off a cliff. And ordinarily, when you see that sort of tax selling, it's done by middle to the third week of December. This time it went literally to T-2. It went right to December 28th, 2 days before the end of the year. And it was just a bloodbath. That's one measure of sentiment. So that's why I think you're seeing some of these small cap, micro cap biotechs really bounce back in Q1, because some people are coming in and they're repositioning. There's a trade to be had. The valuations are extreme, but there's so many other indications. Percentage of companies that traded below cash, biotech companies, upwards of 35%. That's insane. I've been through many biotech cycles. During the GFC, that reading was 25%. We're a third higher on that reading, and it's not the GFC. It's just incredible. Back at the 2002 low in biotech after a 70% bear market, that reading was, again, somewhere in the low to mid 20s. So it's insane the kind of valuations you've seen. Other things that I look at on the sector, the enterprise value to revenue ratio back down to where it was at the GFC lows. The percentage of NASDAQ biotech companies trading below the 200-day moving average back in the meltdown in the middle of the year in June, when biotech really put in its low, that reading stayed below 10% for a month. So between mid-May and mid-June, that reading stayed below 10%. There was only one other time in history that happened. Another thing, I sent you a tweet that I sent out. I did an analysis on 1,300 biotech and healthcare companies, and almost 4% are down 100% from their 2021 high. About a third are down 90%. So all told, 38% are down 90% or more. Another 19 to 20% are down 80 to 90%. It's incredible. So you're looking at almost 60% of the biotech universe, biotech, tech bio companies, and so on, down more than 80%. And a third of the universe. Like these are like Great Depression levels that you're looking at right now. So they've been through Armageddon. And it's reminiscent of where oil and gas companies were in April of 2020. Everything got taken to the woodshed. You remember when oil went minus 37, things like that. Sentiment was bleak. People assumed these companies would never be able to fund themselves out of debt and so on. But what's the best performing sector of the last 2 years? Energy, right? And so you never know at the apex of negative sentiment what the future could be, regardless of what the market does. And we're in a period where we're seeing FANGs get unwound and the crowded trades get unwound. So what we saw at the beginning of the year, we saw a lot of the large cap biopharma companies get hit, and some of the small microcap companies go bid. And so I think we're seeing that trade where they're willing to take a shot at it in Q1 and possibly Q2, and position away from that defensive crowdedness that we saw in the back half of 2022.
Very good. All right. Well, to close us out here today, if you had to make one prediction regarding the biotech industry for 2023, what would that be?
Well, regardless of what the sentiment is, we are in an extraordinary period. I've been through 4 or 5 cycles in biotech, from the 80s, from the inception of the industry, during my university years and high school years and so on to now. And the innovation and the tools that are there to enable an acceleration innovation is beyond anything we've seen in our lifetime. So I think where technology was maybe 30 years ago and all the wonders that we've seen emerge from that, I think we're entering an era where we're going to see the same thing. So we saw the FDA approve lecanemab for Biogen. I think it ushers in a period where we could see tremendous development in things like Alzheimer's disease, where the pessimism is very, very steep. And this goes back. There are parallels between early in my career in the 1990s with HIV. So HIV was a death sentence, and it was just more rapid than it is with Alzheimer's. But so FDA pivoted. FDA said, well, we can't have the standard trial. So you're allowed to use surrogate biomarkers, things like changes in CD4 counts and white blood cell counts and so on. You couldn't wait to have a lengthy, extensive trial in the big population because it's inhumane. So they pivoted and relied on things like surrogate biomarkers, which is what the FDA has done in CNS indications like Alzheimer's. Well, how has A-beta and p-tau changed over time? Things like that. And of course, there's an enormous amount of criticism, but I remember the same thing with what they did with HIV. But there was enormous benefit to the community as a result of what FDA did in pivoting, and enormous wealth created for investors. I remember buying Biochem Pharma, who had developed Epivira 3TC, that became $1 billion drug. Triangle Pharmaceutical that got acquired by Gilead, who had a once-a-day pill. Aguron Pharmaceutical and Gilead. During that devastating bear market in 2001, 2002, when biotech was down 70%, Gilead was up 150%. So, long story short, biotech has that ability to create enormous returns when things normalize a bit. We don't need a sector bull market. We just don't need this devastating, persistent liquidation that we've been through the past 2 years. If it gets choppy and so on, it becomes a stock picker's dream. Because you will find stocks that will generate enormous wealth for investors and benefit to society all at once. It is a virtuous investment. And I think in 2023, it's going to be a stock picker's market. You will find great companies and they will be up 2, 3, 4, 500%. That's what I think.
With that, where can our audience go and find more information on you, Next Edge Capital, follow you on social media, the whole bit?
Sure. I think the easiest thing is just I'm on Twitter, and I tend to avoid tweeting on individual stocks unless it becomes history to me. A couple of companies this year has been acquired, Albrio and Concert that I own. I only tweet about them after they were acquired. And, similarly, but I tend, a lot of the indicators that we talked about today, I'll put that out. And it's really just good faith, just to help you put your finger up and see which way the wind is blowing in the sector. And, enormous amounts of work and resources going to creating and maintaining these indicators and so on. But I put it out there, and that's probably the easiest thing. So it's at Eden Rahim.
Very good. Well, Eden, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Robert, thank you very much for the opportunity to chat about the best sector in the world.
Yeah, very good. Thank you.
Cheers.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.